Hello folks, this is Tyson coming at you with another TCon video. In this video we're going to cover some differences and similarities between the money market and the loanable funds market. And because those axes are both interest rates and quantities of different types of funds, they can be things that students sometimes confuse with each other. So we'll straighten those out and be clear about which types of processes you want to be able to show in each graphical model. And then we'll think about the differences between real and nominal interest rates and connect those via something called the Fisher equation. So the first step here is going to presume you have a bit of knowledge about money market and loanable funds market. They're separate videos I've made about money market and about loanable funds market independently. This will state a little bit of that. And if you're following along to create templates for class, then I would say this kind of information goes on template 8 that connects money and loanable funds market. So thinking about the left column always in blue, here's the money market, and the right column in that dark red is going to be loanable funds. What is our purpose? This will help justify some of the differences we see in the graphs. The basic purpose of money market is to show short-term lending and borrowing from one bank to another. Banks lend in the federal funds market, charging each other the federal funds rate, and they're doing so because they need to have enough reserves to meet the reserve requirement. In reality, they lend what they want to lend, and then they go and get those funds either from the Fed or from other banks later on when the day's over. On the right-hand side, we're thinking about longer-term lending and borrowing, and so these are funds that are going to be lent for business investment, for college loans, mortgages, car loans. And the savings that is the supply of that may come from people who are lending individually, but often it comes from people who are buying shares into some venture fund of some kind that then provides loans, or some kind of lending company. But either way, even if you don't think about those intermediaries, people that are doing saving are doing lending. For the axes, on the left here, we're thinking about quantity of money, and that represents all the money in the economy. Think about a number like M2. If it's M1, that's fine too, but basically that's the stock of money that there is to do everything we do with money in our economy. And because we're dealing with such short-term situations in the left column, we don't need to make an adjustment for the effects of inflation. Inflation's not really going to affect the value of a payment over one day or even a week or a 2-week loan very much. On the right-hand side, we're thinking about the quantity of loanable funds, and that would be a much smaller number probably than the quantity of money in the economy, because a lot of the money in the economy isn't necessarily money that people are seeking to either lend or borrow. So this is just money people are trying to lend or borrow over longer time spans. If we were thinking in terms of millions and billions and trillions on the x-axis, these numbers here would be smaller than those over there. And then because we're talking about loans that for mortgage, you might talk 20 years, 30 years, for a car loan, probably 5, for college loans, longer, business investment, 10 years. You might think of this as being vitally important to say, what's going to be the effects of inflation and how much will I obtain after factoring out the effects of inflation is going to be a really important factor for lenders. And how much you're going to pay after the effects of inflation is a really important factor for borrowers. So that's the relevant price. Think about components of the demand and supply curves. The supply curve in the money market just looks different than normal because it's a vertical line. That means the quantity of money is independent of the interest rate. And the demand curve is downsloping. It's the sum of transactions and asset demand, and that goes back to why we want money. 2 reasons, either to do transactions, and so that's transactions demand, mostly considered to be vertical, and it's influenced by the price level and real GDP. Those are the factors really that shift money demand. When either of those go up, money demand increases. And demand for assets, or asset demand for money, is downsloping because that's back to the question of whether you want to hold your wealth for the future, your store of value. Do you want to store your value in money or in bonds? Well, when bonds are cheap, they pay high interest, you're inclined to do that instead of hold money. When bonds are expensive and interest rates are low, you'd rather have money because it's more liquid. Over here in the loanable funds market, we have an upward sloping supply curve because saver lenders are motivated to do less consumption and save more if they're going to get a higher rate of return after we factor out the effects of inflation. And so that's why we have an upsloping SLF curve. The DLF curve we've talked a bit about that. You just think about institutions that do long-term borrowing. So business firms doing investment and consumers who are borrowing to do interest-sensitive consumption, like send their kids to college or buy a new car, maybe borrow money to move into a house, even if that house isn't going to be part of GDP because it was built the previous year. They're still borrowing a bunch of funds to do that, and then they're going to make mortgage payments over the next 20 to 30 years. And then the third component that we say is the public sector component of loanable funds demand is government borrowing, and that happens if and when there's a deficit. So you think about G and T, G being government spending or government purchases plus transfer payments, and then T being taxes, and the balance between tax revenue and government expenditure dictates whether governments will have to borrow or not. If they have to borrow, they add to that demand for loanable funds. But we always want to be able to think about the private sector demand for loanable funds, that is consumers and firms, and distinguish that from the overall demand. That's when we factor in government. That ability to hop back and forth is critical to really seeing the graph for the loanable or for the crowding out effect. Main use. Why do we ask to students really? Why do students ask to draw the money market? They're asked to draw the money market because they're showing the effects of monetary policy. So that's shifting MS to the right when there's expansionary and left when there's contractionary monetary policy. That's the Fed's way of changing the interest rate, which affects investment and consumption and therefore aggregate demand. On the other side, we mostly want to use this to show an unfortunate consequence, side effect of fiscal policy. So that's the crowding out effect we've worked on a bit in class, and that shows that expansionary fiscal policy creates government borrowing. That expands the demand for loanable funds and pushes interest rates up, which slows capital stock growth and long-run economic growth. Firms don't want to buy as many new tools at the higher interest rate, so they're squeezed out a little bit. And then down here, if you're willing to be patient with it, I've got a rather messy graph on the left of the money market, and what I've shown is the effects of expansionary monetary policy. So this is if the Fed had bought bonds on the open market. They are creating money. They're trading pieces of paper that are not money to banks or to bond dealers. In exchange for money, the Fed is absorbing excess reserves out of the pumping excess reserves into the banking system, and banks therefore can lend more. It becomes cheaper for banks to borrow from each other and cheaper for us to borrow from banks, so consumers and firms do more investment and consumption spending. That would cause a rightward shift of aggregate demand. Over here, we have what happens in the loanable funds market if we do fiscal expansionary policy. So that would be increasing government spending or transfer payments, or cutting taxes, and that's going to cause demand for loanable funds to shift. The distance of this rightward shift is the amount of the deficit that the government now has to borrow. And as a result, the overall demand for loanable funds, this one includes government borrowing, it's higher, and so it pushes up the real interest rate to higher R2 over here, show that increase in interest rate, and then that increase in interest rate causes the private demand for loanable funds has not shifted, but the higher interest rate, it causes the private demanders of loanable funds to say, wait, we don't want to borrow as much. And that decrease in private sector interest-sensitive expenditure is what's reflected in the hot pink arrow there. And that's the one you can show the decrease in C and I that ends up causing that effect, that crowding out effect. And that would slow down long-run economic growth because businesses don't want to borrow as much to buy as many new tools. So one more thing we want to hit on here is how we can connect together real and nominal interest rates. We know in the money market there's nominal interest rate on the vertical axis, and in the loanable funds market it's real. And so how do we connect those? Well, first let's think about, just for sake of simplicity, let's imagine somebody loans $100 and it's going to be paid back in 1 year. That way we can talk about the dollars of interest as equaling exactly each 1% of interest rate. Okay, so if I was going to lend you money for a year, I would think to myself, well, I better charge some interest. And there'd be some reasons why that we can unpack a little bit later. But the purpose of my thought process at this point is to say, what interest rate should I charge you for that $100 loan for 1 year? And so I have to consider within that how much the really true cost you should pay me of being able to borrow money, being able to have some of my liquidity. And it's a bit inconvenient for me to have this IOU from you, whether we call it a bond or just a debt. You owe me money, and I can't transfer that into goods and services over the short term. I also can't lend that to somebody else at interest. So that's part of it. And then another part of it is I'm trying to figure out how much will prices increase over that year. And I don't know precisely how much prices will increase from right now to a year from now, but I have to take a guess. And so the big idea that we're shooting for here is the notion that I'm going to say, how much should I increase my purchasing power because I'm giving you my liquidity, and then I need to add to it whatever I think will be the rate of increase in prices. So I'm going to take the real interest rate that I think I should charge you based on your likelihood that you're going to flake out and not pay me back, or the inconvenience of having an asset that's less liquid in the short term here. And then I'm going to add to it however much I think prices are likely to rise. And I add those together, and maybe I think that prices will rise here. Let's see what we can do with this. Maybe I think, given the rate of likelihood that you won't pay me back or something like that, that there's sort of a 6% cost of loaning you money, and then I expect that prices will rise by 2, and so I charge you a nominal interest rate of 8%. We drop a contract, and you're going to pay me $108 in a year. So that would be the way I would calculate the nominal interest rate, how much you will actually owe me in dollars 1 year from now. When we fast forward into the future, now let's imagine zooming ahead to 1 year from now in time. And now we know already how much you owe me. You owe me $108. And because we've already set the nominal interest rate. So you owe me that. And to figure out how much actual increase in purchasing power I got, I'll need to subtract from that however much got eaten away by rising prices. But I don't need to do an expected inflation rate anymore, because now I know how much the level of prices went up. That's pretty messy there. Now it's just messy instead of pretty messy. Okay. Well, let's think about how that might work in practice. Okay. I charged you, we know, $8. Okay. So here's this 8% interest rate because you paid me back $108. So I have this $8 worth of interest. And let's say that prices went up by 2%, then I would have the ability to buy the same quantity of goods that today I could buy for $106. So with that $108, I could pretty much buy a bigger pile of stuff than what I could have with the $100 I lent you. I could buy a pile of stuff that's worth $106 today. So that would be my 6% real gain net of inflation. Well, what if the inflation rate wasn't what we thought? This is actually a good way to reinforce something we've learned a little bit earlier. What if the interest rate or the inflation rate, goodness gracious, I keep confusing those, and the whole point is to help keep them straight for you. But what if the inflation rate was 5%? So now I have my $108. I go to the store and prices are 5% higher. So it costs $105 just to buy the stuff that today would cost $100. And so really I can only get 3% more stuff. So my real rate of return was lower than I would have thought or would have hoped at the time of the loan. And this idea here that if inflation was faster than we expected, I end up getting a little bit less back than I thought I would have. That should connect to something we learned in Unit 2, which is that when inflation is greater than expectations, borrowers benefit and lenders lose. In this case, I was the lender, and instead of getting 6% real rate of return, which I thought I was gonna, now I only get 3. Okay, let's flip that around real quick and just make sure that it's clear when we go the other way. We know this is fixed. We wrote this contract a year ago and it was said you're going to pay me $108, so that's not changing. But what if now the inflation rate, let's do an extreme example where prices actually were down 1% from the time of the loan, right? So they actually decreased 1%. Well, I think you can figure out now 8 minus -1, that means I got a real interest rate of 9%. So let's think about what that means. Now I go to the store. I fill up my cart with all the stuff that today it would cost $100 to buy, and that only costs $99 because the price level went down 1%. And so now I actually have $9 more that I can go buy some goods. And in fact, I think real interest rate might be just a tiny bit higher than 9%, but this is such an approximately equal to thing that you can just keep it as equal if you want. And what have we learned here from that? We have learned that when inflation is less than expected, we expected 2 and we got -1. When inflation is less than expected, borrowers lose and lenders benefit. So I end up really doing well under this type of a situation. Last little bit to think about here is just to clarify for us, why is it, that's not good, why is it that lenders are logically or morally justified in charging interest? They have a risk of non-repayment. There's a possibility that the person won't pay you back, even no matter how great their credit score is. But this is a thing where if you're a lender, you estimate this with the credit risk, and this you'd bump it up a lot if the person was really likely not to repay you, and you'd charge a really low amount to the types of people who are likely to repay you. And lending involves a sacrifice of liquidity and acceptance of payment later. I am trading away $100 today for $100 a year from now. And that should entitle me to a little more than $100 because we know from past study that a payment today is more valuable to us than a payment of the same amount in the future. So that's future and present value. And then we also know that prices generally rise. So the same amount of nominal dollars won't have as much purchasing power a year from now as it does today. So those first 2 reasons justify a real interest rate, and the third one is the inflation premium. If you imagine a place where there's 0 inflation, you would ignore this third one, but the first 2 would be good reasons to charge a little bit more than you lent out. So this summarizes that idea as well, and so you can process that a little bit yourself, and I will thank you very much for watching and hope that you come back and watch future TCon videos, and feel free to subscribe to the channel if you like.